Big action from the Bank of England this morning. It's stepping in to buy long-term bonds in an attempt to stabilize markets. The central bank also suspending asset sales, hinting at more rate hikes as well. And here in the U.S., recession fears are on the rise ahead of inflation data this week. Here to make sense of it all, hopefully, to help us with that is John Hancock, Investment Management's co-chief investment strategist, Emily Roland. Emily, it's good to see you. I do want to start with the UK because that was such a dramatic action there and is obviously in direct response to what we saw in terms of the government plan that was announced over there. But it sort of gets to the bigger issue of the sort of fumbling in the dark feeling that we are getting from policymakers globally, as well, both on the government and on the monetary policy side. How are you thinking about all of this?
Yeah, I heard another strategist this morning, Julie, call this quantitative confusion. You know, we're not doing QE, we're not doing QE, or QT. You know, at the same time that we have the Bank of England, you know, raising rates aggressively here into inflationary pressures, we have policymakers in the UK, you know, implementing massive fiscal stimulus. And I think that this just goes to show that there probably isn't a place for fiscal stimulus during a time of elevated inflation. So when you want to pursue fiscal, you've got to issue more bonds. That is going to weaken your currency. And then you've got a big problem on your hands here. So I think that what the Bank of England is doing right now is necessary in order to restore order to those markets, but certainly creating a challenge globally. And then you've got the commensurate reaction here from bonds in the U.S. You know, bonds globally do tend to move in sympathy. And some of the big sort of reasons for the backup in bond yields we've seen in the U.S. has been from, you know, foreign forces or foreign elements. So we're seeing that work the other way now, which is one key reason here that equity markets are catching a bit of a relief this morning.
Emily, when you talk to clients, do you get a sense that they are inclined to continue selling or just get out of the market? I'm just trying to get a sense on when we might see some type of short-term bottom, or there could be a new fresh wave of selling and takes these markets down even further.
Yeah, Brian, it's a great question because just over the last couple of weeks in my conversations with financial advisors, I'm starting to hear words like, you know, my clients just want to get out. I'm starting to hear more sort of, words like capitulation. And when you look at what's just happened, we just saw the worst year in history so far for the aggregate bond index. You have to go back to the 30s to see a worse. And I don't think many of us were investing in the 1930s. We just saw the fourth worst start to the year for the S&P 500 in history, and the third worst start for a balanced 60-40 portfolio in history. So these are the most challenging markets that we've seen, many of us in our career. The good news is, I know that all sounds really awful, is that years after these more challenging years tend to be a lot better. But I think the big challenge for investors right now is looking to try and stay invested. And our view right now is continue to do that. We don't think the 60-40 portfolio is dead. We want to own higher quality assets and equities as well as in fixed income. And we're very much focused right now in getting that income, getting paid, moving up the capital structure, and waiting out this very, very challenging macro backdrop.
I guess kind of to fuse together two different points within that answer. You're saying earlier that the clients, they're calling you, they just want to get out. So where are you kind of recommending that they turn to? Where are they then turning to at that point and taking some type of action on? Or is it just kind of a sideline period, and for how long?
Yeah, certainly we're seeing a lot of clients going to cash. You know, they're embracing CDs right now just to, you know, kind of load up on the safest assets. But we want to be really mindful here of still, you know, having an equity component to the portfolio. Again, wanting to look for higher quality companies. To us, there's a massive dislocation in the market, given the fact that the quality factor is actually underperforming the S&P 500 this year. We're talking about companies with great balance sheets, good return on equity, more earnings stability, ability to maintain margins, even in a global economic growth slowdown. And those companies have gotten hit. So we find those on sale right now. And then we want to embrace more classically defensive areas of the market. We're seeing a huge shift in consumer behavior just starting to play out. As rates have gone up, commodity prices remain elevated. Consumers are eschewing the things that they want, but they're still going to embrace the things that they need. They're going to turn the lights on and take a shower. So we're looking at things like utilities, infrastructure, things like toll roads, data centers as being something that's a great place to hide out right now. And then again, on the fixed income side, we want to be underweight credit here. We do think that liquidity could become a concern. We are watching high yield spreads widen here, not to historically high levels by any means yet, but probably some further pain there. So notching up on quality, investment grade corporate bonds, mortgage-backed securities to us are the best place to be today.
The shower trade, as Brian Sozzi is now dubbing it. Thanks
for calling me out. Appreciate it. I do it all the time. I guess I got to get it sometimes, so that's all right.
I mean, you look pretty clean, Brian.
I do. You got it. You can't show up here, dirty
don't
and
give
smelly.
up on that. All right, Emily Roland, thank you so much. Sean Hancock, Investment Management's co-chief investment strategist.